Hello, my name is Gabe Bodner with OneTrust Home Loans, and I've got a question for you today. Have you ever had a client want to compare a home equity line of credit to a home equity conversion mortgage? I'm sure you have. I certainly have. And I want to teach you a technique that works very well for me.
At Atlas Valuation, we approach the appraisal process differently. For us, it's not about being the biggest. Instead, we take pride in providing the very best to our chosen clients and emphasize delivering a superior borrower experience, unrivaled service, competitive pricing, and prompt delivery. To learn more, visit atlasvms.com or call or click on the banner below this video.
I'll take a yellow pad of paper and I will draw a line down the middle of the page and across the top. Some people call this the Benjamin Franklin technique, okay, where you outline pros and cons side by side. And I'll put at the top of one side, HELOC, and I'll put on the top of the other side of the page, HECM, home equity conversion mortgage. And I will outline once again the pros and the cons of each product for the client. And here's how I'll start. I'll say, let's look at the HELOC. Okay, let's talk about the pros of a HELOC first and foremost, home equity line of credit. Number one, it has a low upfront cost, okay? Compared to a HECM where you have a higher upfront cost, okay? The second benefit of a HELOC is you get access to cash, short-term money. That's it. Those are the two pros, the two benefits of a HELOC compared to a HECM. As far as I'm concerned, those are the only benefits when you compare these two products side by side. Then I'll go into the home equity conversion mortgage and I'll talk about the benefits. So number one, you don't have to make payments. The home equity conversion mortgage is such a great product because you're not required to make payments, but you're allowed to make payments. Let's look at the HELOC. Not only are you required to make payments, but after the first 10 years, which is the draw period, where you're allowed to make interest-only payments, after that, your payments are going to increase because they become fully amortized with principal and interest over the remaining term, which becomes extremely dangerous. Unlike, again, the home equity conversion mortgage, where you're not required to make payments. So, a plus for the home equity conversion mortgage. Number two, with the HELOC, okay, you get approved for a specific credit limit, and that's it. You have to refinance in order to increase that credit limit, which you have to pay fees for when you refinance. Unlike the HECM, the home equity conversion mortgage, there's a guaranteed growth rate associated with this, meaning your available funds are going to increase over time based on the interest rate plus 0.5%. So again, your HECM gives you guaranteed growth compared to the HELOC, which has a fixed credit limit. Number three, the HECM, okay, allows you to access the funds as long as the loan is in place, okay? So as long as the homeowner is living in the property, continuing to pay taxes and insurance, HOA dues, and maintaining the home, keeping up with the loan effectively, okay, the loan is guaranteed. The funds in the line of credit are guaranteed. That's part of the upfront costs, which is ultimately a benefit compared to the HELOC, where that credit limit can actually be frozen or decreased or taken away at any time by the lender. It's not guaranteed, okay? So again, the HECM, guaranteed growth and guaranteed accessibility. Number four, it doesn't have a due date, okay? The HECM, that is. You can allow this loan to defer interest, not have to make payments, and not have to pay this off as long as you're living in the house. You could live to be 125 years old, and as long as you're living in the house and paying taxes and insurance, you do not actually have to pay this balance back. Unlike the HELOC, which typically has a term, whether it's 10 years or 15 years or 20 years, where it does require repayment. So once again, that can become dangerous as we age and potentially loss of a job, loss of a spouse, health situation, all of those things as we age. Now you're being forced with this HELOC into a larger payment and have to pay it back. Where the HECM, once again, does not have to be paid back as long as you're living in the house and paying taxes and insurance. Okay. Additionally, a home equity conversion mortgage does not have a prepayment penalty. You can pay it off at any time. You can sell the house, you can pay it off, you can pay it down. There's zero penalty to do that. With a HELOC, there might actually be a prepayment penalty on that product. So yeah, there might be less upfront costs, but you might have costs down the road, again, if you pay this loan off early. Next, a HECM, home equity conversion mortgage, is insured by FHA. This product is insured, guaranteed, and non-recourse. Okay, because of that upfront mortgage insurance, it creates this as a non-recourse mortgage. Unlike a HELOC, which is a recourse mortgage, it's not government insured. The line of credit is not guaranteed. Okay. Additionally, a HECM does not have any annual fees. The interest in the mortgage insurance can be deferred and added to the balance, but there's no ongoing costs, unlike a HELOC, which typically has an annual fee. So again, in summary, if we go back to the top line and we reiterate, the plus that we talked about with the HELOC is it's a lower upfront cost. But when you consider all of these other potential costs over time, it might equal out. In addition to that, both of these are adjustable rate mortgages, but with a HECM, if rates go up, you're not required to make a payment. So it doesn't negatively impact your cash flow. And in fact, if rates go up, you see a larger growth rate on your line of credit versus the HELOC. If rates go up, guess what? Your payment goes up, negatively impacting your cash flow. So after all said and done, when I outline the pros and the cons and I compare these two products side by side, it becomes extremely evident with clients where they turn their attention to the HECM and look at it and say, wow, I can absolutely see the value in this product and the benefits, which certainly outweigh the upfront costs, which in my opinion is really the one downside to the HECM when you compare it to the HELOC. Hopefully this helps you compare a HELOC to a HECM whenever you have that come up. And I wish you best of luck in all of your sales conversations and serving more and more clients every single day.